Chapter 2 from the Chp2 Intermediate Accounting book, 16th edition. We're going to be looking at the conceptual framework for reporting, and it's really about why we do what we do. These are the ground rules in accounting. Now, the development of the conceptual framework, the FASB has issued 7 statements of financial accounting concepts for business enterprises. The first one identified the objectives of financial reporting. The second one, the qualitative characteristics of accounting information. And the number 3 is the elements of financial statements. 5 was recognition and measurement in financial statements. 6 replaced number 3 in terms of describing the elements of the financial statements. Then 7 was using cash flow information and the importance of present value in accounting measurements. And then 8 superseded 1 and 2 in terms of the objectives of the general purpose financial reporting and qualitative characteristics of useful financial information. The conceptual framework has 3 levels. The first is the basic objectives, is the purpose of accounting. That's what it defines for us. The second level is the qualitative characteristics and elements, i.e. accounting terminology, what the words mean. And the third level is the recognition, measurement, and disclosure concepts, the rules. The important one for this class is the third level, because those are the ones that set ground rules for recording financial transactions. First level, basic, objective, purpose of accounting. The outcome of reporting is to present a fair and accurate picture of a company's financial position to informed users. The second level, quantitative characteristics and elements, the accounting terminology. What qualities are required to ensure a faithful representation of a company's financial data? What are the elements of accounting and how are they defined, such as assets, liabilities, or equity? The qualitative characteristics, first of all, they have to be relevant. Do they have predictive value? Is the information helpful for users to meet expectations about the future? Confirmatory value. Does the information validate or refute expectations based on previous evaluations? Materiality. Have we included all information that would affect the decision of an informed user? Also, what we have to have is faithful representation. Completeness. Is all the necessary information provided to the informed user? Neutrality. Is the information unbiased? And finally, is the information free from error? Is it accurate? In addition, we have qualities such as comparability. The information should be measured and reported in a similar manner if in similar businesses. Consistency is another type of comparability, and it means the company uses the same accounting methods from period to period. Verifiability occurs when someone like an auditor using the same methods obtain similar results. And timeliness. Provide information to decision makers while the information is relevant for decision making. This has become increasingly challenging because of the internet. And understandability. The information is presented in a manner that is understood by informed users. Concept statement number 6 defines 10 interrelated elements that relate to measuring the performance and financial status of the business enterprise. We have ones that are called a moment in time. What they're telling us is this is what we look like right at this point in time. We do that when it comes to assets, which are defined as anything that has probable future economic benefit to the company. Liabilities. These are probable future sacrifices of economic benefits arising from present obligations of the entity. Equity, it's the difference between our assets less the liabilities, or it represents ownership interest in the company. Period of time. We have investment by owners. The difference again between assets and liabilities. This is what investors have transferred to the entity. Distribution to owners, decrease in assets. Usually this is done by distributing assets such as paying dividends. Comprehensive income includes all income as well as items that are far removed from ongoing activities. An example of other comprehensive income would be unrealized gain or loss on available for sale securities, or fluctuation in currency values. Revenue, inflows or enhancements of assets during a period from delivering or producing goods or rendering services, and is part of ongoing activities. Expenses is what we've had to consume to generate that revenue. Gains and losses are any types of activities that are outside the normal scope of the business. Now let's go to the third level, which is how do we define certain types of activities? Now first, the economic entity concept. A company must report only its own financial activities. This is particularly difficult when it comes to small businesses, which tend to combine personal as well as business. Going concern. A company has the resources to fulfill its financial objectives and commitments. If a company is identified as not a going concern, it means they do not have the financial resources to do this. Monetary unit. Money is the common denominator. We, in accounting, focus on recording financial transactions. This used to be the dollar. However, with the international markets, now we just say it's whatever currency they're using. Periodicity. A company can divide its financial activities into time periods, such as months, quarters, or years. How do we measure? Well, there's two ways we can measure. It used to be only historic cost. We record assets and liabilities based on acquisition costs. This used to be the standard. But as we tried to merge with the international standard, we started going more toward fair value. And this is defined as the price that would be received to sell an asset or pay for a liability in today's dollars. GAAP is now requiring that fair value be used in parts of the balance sheet. Basic principles. We, of course, have the revenue recognition principle, which it had just gone through a major change, and now there is a 5-step process in terms of when we recognize revenue. But the criteria is we recognize it when the exchange is complete or satisfied. Expense recognition. The expense follows the revenue or expense when consumed. Now this has two parts. One, if there are production costs, they're recognized when revenue is earned, i.e. the item is sold. Period costs are expensed when incurred. An example would be an executive pay or advertising costs. Full disclosure. Provides sufficient information that would affect the decision of an informed reader of the financial statements. Again, full disclosure, it's not the dollar amount, it's the effect of the activity if it was not included. Now finally, we have to look at cost constraint. We have to compare the cost of providing financials versus the benefit. Last, the IFRS compared to GAAP. Although since 2010, GAAP and IRF have been working to become similar, and their goal actually was to become similar in 2012, however, it is unlikely that it will merge into one standard. An example is LIFO is acceptable under GAAP, but not under the international standard, and I don't see this changing anytime soon. Now that completes Chapter 2.